First, the Fed cut interest rate to zero quickly in March, and they restarted the quantitative easing. And eventually, using forward guidance, they ensured that the market understand that the Fed will provide as much liquidity as the financial system needs. And furthermore, the Fed quickly set up 7 emergency facilities, and those facilities prevented the credit markets from seizing up, and it also kept credit to households and businesses. So I think on hindsight, it's pretty clear that the decisive and swift action by the Federal Reserve, as well as by fiscal response over at U.S. Treasury, Congress, and the White House, these actions prevented a complete collapse of the economic system. If I were to point to one thing as a culprit for the Fed making the inflation forecast mistake, I would think it would be mainly institutional groupthink. And the Fed has done a lot in introducing diversity into the staff at the staff level, but along the dimension of gender and racial background. But the other kind of groupthink is political and also economics training. Most of the economists in the Fed are trained in a certain fashion, from a standard PhD economics program, and that's not really the Fed's, mistake. It's more of an economics profession as a whole, and the Fed is in the business of hiring from these programs, and so all of the economists kind of have these tools, standard tools in their hand and brain in thinking about this problem. Phillips curve. Phillips curve is flat, and just 2 years before the pandemic, OECD hosted a working group in trying to understanding whether Phillips curve is flat or dead, and the consensus is that yeah, it's flat. And so when the Fed looks at the inflation from the lens of a flat Phillips curve, they would think that even a very hot job market would not produce any inflation pressure, and we now know, like from actual wage data, that doesn't seem to be the case. Second, the idea that inflation expectations is the most important thing in keeping inflation low. I remember in the spring of 2021, and this is to the Fed's credit, the upper management directors were instructing staff to think more deeply about how inflation expectations affect inflation, and what kind of indicators should we be looking at to gauge whether expectations are unanchoring. And I remember that the answers from the staff is like, nobody really have a good handle of that. But yet, even despite not having a good handle of the exact mechanics of how expectations influence actual inflation, those measures continue to play an outsized role in the forecast, in generating that complacency about inflation. And it is not until later last year and early this year that now, as an outsider looking in, I think that the Fed staff thinking on this is evolving. I've seen increasing research coming out of the Fed, clearly attributing demand as playing a role in the high inflation. I've seen a paper from Jeremy Rudd, who actually acknowledged that we don't know how inflation expectations influence inflation. In fact, he downplayed the confidence that anybody should pay into any complicated mathematical equation that feed expectations into inflation. In fact, he pointed out that it's simpler than that. It's really a function of whether inflation is on your radar or not. And that kind of statement, in order to carry any authority or weight in the Fed's process, needs to be coming from somebody very senior. So I think the culture in the Fed is you got to have a paper under your weight or publishing in order for your view to be taken really seriously. And when we are at times like the pandemic, where everything is unusual, where any models that's fitted on data from the past 20 years don't really apply, then and you are making a decision based on with a very high threshold of publishing quality, it's kind of hard to be swift and agile in tailoring your response. So and on the political groupthink side, as I was saying, I worked for a year in a Republican CEA, and when I came back to the Fed, I clearly observed the differential weight that the organization placed on thinking about the possibility that the fiscal stimulus might be too much. I think it played a role in Bloomberg Economics. We put out a piece last December showing that if you look across countries, US inflation is uniquely high and higher by about 3 percentage points that before the Ukraine war. And I can see that increasingly Fed staff is coming to that view as well. There's been research from San Francisco Fed, from the Board of Governors that point to 2.5 to 3 percentage point as being contributed by fiscal stimulus. I think Fed Chair Powell has been very clear in his recent communication that price stability is the priority of the Fed right now. That if the Fed were to lose price stability, that the impact on the lower income quintile of American households would be even worse than if there were to be a recession. So from a cost and benefit angle, the Fed has come to the conclusion that the cost of losing the inflation anchor is higher than the cost of having a recession. One culprit of the myth on inflation is that the model-based approach to inflation forecast, those models have some assumptions that appear to have broken down during the pandemic. So if a central bank relies excessively on only one particular framework of inflation forecasting, such as using just relying on Phillips curve approach of inflation forecasting, that would be misleading. So I think the lesson is that one should be incorporating a range of and different approaches of forecasting inflation that would involve bottom up, top down, and a risk-based approach where you're forecasting the entire distribution. But the thing is, I do feel that the Fed already have those toolkits even during the pandemic. And partly it is because those toolkits, all three toolkits failed because the data in the last 20 years just do not indicate this kind of inflation risk. I guess it could be, the lesson could be as simple as maybe extend the sample period to 50 years rather than 20 years.